Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Good morning.
Hi, good morning. Thursday morning. I'm a bit confused. Do you think the cues are positive because US markets have rallied? Brent is still at $101 per barrel. So all that, sort of points to that maybe we are closer to the end of the road. But then on the other hand, you've got Iran retaliating, sort of mocking, saying that Project Trust Me Bro has failed. So that doesn't really, give you confidence that a deal is perhaps in the offing.
Well, if I had to put my neck out, I would say I think de-escalation more than escalation is what I think. And maybe we're moving towards the end and directionally crude prices are down. Maybe I could be wrong, but I think...
trust the prices, right?
I think directionally, I think crude oil prices should move down and hopefully it'll be a better setup for equity markets. But it's just a guesstimate.
Well, it's just amazing, right? Amazing times we live in. This is the point that I made yesterday as well, that it's felt for a while now, right? This is closer to the end than to the beginning, but it's like a game without a set of innings. I mean, it's an endless match with at some point there will be something which will happen. But we don't know yet. But of course, yesterday was consequential, last 1 hour specifically, because the news hit at about 2:20, 2:25. So let's take it from the top. Markets last night responded like we did yesterday. And, they rallied on hopes of US-Iran are getting closer or nearing a deal to end the war. So, basically what they're doing is apparently both sides are working with mediators to draft like a one-pager memorandum of understanding, which will be the framework on the basis of which talks will be held, either in Islamabad or in Geneva, most likely in Islamabad, starting next month. That is what all the report suggests. And the talks, by the way, are expected to be a month long. I mean, they're expected to go on in that sense. Now, U.S. equities rallied to new highs. We, of course, had our own surge yesterday. I'll get to our levels in a bit. But S&P was up 1.5. The Nasdaq was up about 2% or so. Oil fell 8% overnight, and we are near the 102-odd dollar per barrel levels. I mean, it's not a big surprise for us. I mean, maybe it's a little lower than where we were at 8. We saw what? We saw about 107, 106. Actually, we saw 106 yesterday by about 3:30. So, markets were trading with oil at 106, and we are at 102 this morning. So, yeah, it's about $4 cheaper, but the big action, of course, happened during the course of the day, the course of the session, our trading session yesterday. And, of course, I mean, it overshot on the downside. It broke 100, and we hit about 95, 96, 97, and then, of course, there was a pullback from the lows as well. But, while we were trading 106, we're about 102 right now. Now, 10-year Treasury yields, as a result, I mean, we were talking about how bond markets rates were trying to price things higher. Of course, they went backwards. So 7 basis point fall on the 10-year, 4.35. The 30-year, which was at 5 plus, fell about 5 basis points, about 4.94. We had some jobs numbers, the private payrolls number, which came through. It grew the fastest pace in more than a year. But the big non-farm payrolls data will come on tomorrow after around the time when markets open. That's when the data comes out. Now, just comments, right? President Trump posted this. I mean, actually, he said this. So he said, Iran cannot have a nuclear weapon. They won't. And they've agreed to that, among other things. He went on to say that we've had very good talks, and it's very possible that we'll make a deal. Of course, Trump warning Iran that, and this is all, courts basically putting it together. Bombing starts again if a deal is not reached. So there is, that hope, but there is also the warning. And what that warning and that ultimatum and that sort of, that does is that it gets a response from the Iranian side as well. And that's perhaps, I think, fundamentally a problem as well. A deal will be made if both sides are ready to get on the same page in terms of messaging to the world as well. The problem here, of course, is that you want to end the war, maybe de-escalate in a genuine way, but signal to the world that has happened because, well, I threatened a bomb. And of course, this is the response, and it'll come up on your screen. This is the Speaker of the Iranian Parliament, and some of the flashes are there at the bottom of the screen as well. He says, Operation Trust Me Bro failed. Now back to routine with Operation Foxius. I mean, Foxius, of course, a take on the Axios news website, which reported that there is perhaps some amount of discussions underway, that they've never been closer to some sort of an agreement. So that's how you had to weigh things. But so far, looks like, despite all the jabs and pokes at each other, we'd have just had to go and trust on the fact that maybe there is something happening, and there are some talks which will take place once again. So we'll see. Now, the rupee fell 70 paisa yesterday, and, it's a big one. 94.35 level. Watch that. It's about 30 odd paisa away. You basically will fall back into the rising trend line channel, and once that happens, we close below 94.35. Maybe, at least in the very near term, the downdrift in the rupee perhaps is behind us. So 94.35 is crucial. The Nifty, of course, once again, the range we put out was 24,300 on the upside, 23,800 on the downside. And we, led by the Axios report, surged in the last hour to beyond 24,300, 24,330 odd was the close. Now, 24,300, of course, becomes important. I mean, let's hope we stay above it. And then the targets are 24,685 in the very near term. Supports, of course, are 24,300 and 23,800. That's the lower end of the range. It's all news-driven, so it makes it tricky. You'll almost get a sense that this is a very, even trading-wise, right? I mean, there's so much happening, there's so much action and all of that stuff. It's target-rich, but it's also highly complex, and trading headlines, trading news flow is always very, very tricky because they tend to change. GIFT Nifty is absolutely flat, and that's because, as I said yesterday, bulk of that fall in oil prices we reacted to with that big surge that we got. Nigel has walked across with the F&O positioning, the cues. Nigel, take it away.
Well, the flip-flop continues, right? Both from the United States as well as from Iran's end. And, there was some nervousness actually that crept in. This after Mr. Trump said that a deal was not finalized and also threatened to resume military strikes if, Iran doesn't comply. So that's a bit of, caused some kind of nervousness. But there were encouraging comments coming in between Iran as well as the Chinese foreign ministers. And just to quote, the Chinese foreign minister Wang Yi called for the strait to be reopened as soon as possible. I think, that is a positive because, when both these two names, they get together, and it's the first visit from the Iranian foreign minister to China since the war broke out. And with a comment coming like this, I think I'll read this very, very positively, the exchange between Iran as well as China. Let's see how that goes. But the troika overnight, that's well behaved, and you like that from an equity market perspective because you have the dollar index that's a little bit softer. Remember, a few trading sessions ago, it was holding at around 98.5. That's back below the 98 odd mark. The yields have cooled off a wee bit, and Brent crude prices as well, a little lower in comparison to what we closed out yesterday. So that's good. Yes, it's bounced overnight, but the troika is well behaved. And what was positive yesterday was the Indian rupee. That showed some strength, some stability after a while, and you want that to continue. The Nifty Bank as well went ahead and it conquered the 20 DMA, so technically as well, that is pretty good. And the Nifty at least ended above the 24,300 odd mark. You want all these three trends to continue for today's trading session. And though the rupee showed some strength, there was no luck with regard to flows because the FIs is sold close to 5,000 crores yet again. But if the rupee can hold on to its own and maybe show some signs of strength, I think the flows will gradually come back because the FIs have been underweight India. Things seem to be coming together on the domestic front. So I'll keep an eye out on this FI sell number. You'll want this number to cool off. But the DIs, at least for yesterday's trading session, they offset all of that. So institutions were net buyers in trade yesterday. On index futures, though, the FIs, they went ahead, and after a while, they added more longs than shorts in the ratio of close to around 3:1. But you need to know that the short position continues at around 87% odd. On stock futures, though, if you look at it, well, they did the same. They added more longs than shorts in yesterday's trading session, telling you that individual stocks will continue to show strength and do things of their own. In terms of the options data, well, the 24,900 call. Now, there is some enthusiasm that's creeping in, some kind of optimism as well. So that it appeared there was some out-of-the-money call buying at that particular strike. Premium at around 39 rupees. So all you lose is 39 rupees if in case it doesn't work out. And yesterday, the premium moved up as well. 11 lakh shares getting added there. But there are clear signs that in the near term, there is writing being seen at around the 24,500 call as well as the 24,200 put. Both of them seeing a good amount of open interest and the premium between 100 to around 150 rupees. So looking at, those levels, the way we saw the option writing yesterday, We'll get to the levels in just a bit. But yesterday, there was also a bullish crossover that took place on the Nifty itself. What does that mean? Well, you see both these two, the 20 as well as the 50 DMA. That's, the important mark out there. So it appears they're heading towards a bullish crossover over there. We'll want to keep an eye out on this range itself, at least for yesterday's trading session. The Nifty got above those levels. Levels to track in the near term. Resistance comes in at around 24,500. Extremely important mark. Remember, this level got rejected the last time around, so you'll want to keep an eye out on that. On the downside, the recent low that we saw just a couple of sessions ago was at around 23,900. You'll want that to hold out, and that becomes the first reference point on the downside. The Nifty could be in a bit of a range, but I think the strength in the broader market is heartening. The number of stocks advancing more than the number of stocks declining. Even in yesterday's trading session, you had the mid as well as the small cap indices. They're doing far better. That's giving you a sense that domestic participation as well as larger names, they believe that we're closer to the end of the war rather than the start, and they're willing to look ahead that the economy will gradually recover. And that's why we've seen consistent outperformance in the broader markets, and I think that will continue. Individual stocks will do a thing of their own.
All right, thank you very much for that. A quick check on Asia before we proceed. The Japanese markets have reopened after 3 days of a holiday, and they've come back in style. It's a 5.5% rally on the Japanese market. The Nikkei crossing that 62,000 mark for the first time ever. The gains continue for the Taiwanese market, 2% up. Hang Seng holding up nicely, 1.5%. And the Korean markets too are holding up in the green. It's up about 0.5%. But we're back to tracking headlines particularly coming out of President Donald Trump, who said he had very good talks with Iran over the past 24 hours, and it was very likely that a deal would take place. Listen in.
Look, if we left right now Iran, it would take them 20 years to rebuild. You would call that, we're in good shape, right?
Fantastic shape.
We're in good shape. And now we're doing well. Now we have to get what we have to get. If we don't do that, we'll have to go a big step further. But with that being said, they want to make a deal. We've had very good talks over the last 24 hours, and it's very possible that we'll make a deal.
Okay, let's invite Prashant Paroda, Portfolio Manager, Emerging Markets at Allspring Global Investments. Prashant, thank you very much for joining in. Global markets across the board are rallying very nicely from their March lows. It's a ferocious comeback in the US for the NASDAQ, AI-driven trends like Kospi and Taiwan. Is it time to just ignore the news, the headlines related to the geopolitical tensions, and keep riding this wave? What are you all doing at Allspring, and particularly the view on India now?
We've been actually, our bets have been working out throughout March, and especially in Taiwan and Korean market, which continue to be strong with the AI wave. With regards to India, we're still conservatively, cautiously optimistic. A lot of stocks have fallen in India. Some maybe because of the oil and the Middle East issue. But if this gets resolved, and possibly there's a President Trump's visit to China in 10 days, and the Chinese premier and foreign minister actually met the Iranian foreign minister. So we think there's a lot of stuff going on the back, which makes us feel cautiously optimistic that this is coming to a close, and a positive close.
Well, the first time you said conservatively, cautiously optimistic, Prashant, that's a new one. What does that really mean? What are you buying in India right now? What are you avoiding?
So we're looking at stocks that have rallied from the March. Some stocks have really rallied very abruptly. We think they're kind of ahead of expectations. Some of the renewable stuff, some of the power stuff has done really well this year. We're looking at sort of the laggards in the market where expectations are low. And we're looking and cautiously looking at whether the downside is limited. And once this war gets resolved and all the chatter about higher inflation sort of dies down, we could see rally in those pockets as well.
Yeah, got that. Prashant, just what do you own as far as power, the power and power infrastructure theme is concerned? Do you own anything here in India?
We've not talking specific stocks, but we've owned some of the largest players in this space, and I think those have done well so far this year. And as you remember, Prashant, the power story in India, uh, there are years when it's very strong, and then there are years which demand seems to kind of be lackluster. This year seems to be a strong story, but these are sectors where there is some cyclical element as well, rather than structural elements. So if the stocks have run far ahead, and we think it's time to take some gains and look at parts of the markets which are private banks, which haven't done as well throughout this whole episode.
All right, Prashant, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for being here on CNBC-TV18. Well, I'll just quickly run you through what's coming up here on the program in terms of the guests. So interactions, we've got 8:35, a discussion around the defense sector, the first anniversary of Operation Sindoor. So you'll hear from Girdhar Aramne, the former Secretary of Defense, and Ashok Atluri of Zen Technologies. 9 o'clock, we'll have Mahesh Barang to put the spotlight on Shree Cement's. 9:15, Manish Gudmani of Bandhan AMC talks markets. 9:25, the management of Coforge is going to be with us. We'll be speaking with the management of Blue Star on the fourth quarter earnings and outlook. Bajaj reported numbers, strong numbers, and we'll talk about their earnings. CG Power also reporting earnings yesterday, and we've got the management joining us there as well. Lata will be speaking with Sridhar Sivaram of Enam on how Indian stocks compare with their EM competitors at 10:15.
Time to slip into a short break, but on the other side, we go full tilt on stocks in our special top 10 segment. For the time being, I run you through the list. Bajaj Auto, Godrej Consumer Products, Shree Cement, PB Fintech, Paytm, all of them will be reacting to positive news flow. Home First Finance, Blue Star, as well as Arvind. So 8 stocks reacting to positive news flow, while Misho and Hexabear will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC TV18's list of top stocks for the day. Bajaj Auto is top of mind. Sudarshan joins in with his read on the numbers. Morning.
Good morning. So it was a strong set of earnings for Q4 FY26 from Bajaj Auto, and apart from the earnings, company has also announced the share buyback of more than 5,600 crore at a price of rupees 12,000 per share. But if you talk about the earnings, revenue was firmly led by the strong volume growth that company has seen both on a sequential basis as well as YOY. Volumes were up 24% YOY and also up almost 2% on a sequential basis, and that has also helped the company, and the price hike increase that we have seen over the last few months has helped company to improve the realization. It has improved by 6% YOY and 3% on a sequential basis. So talking about the headline numbers, profit has increased by 34%, revenue was up 32%, EBITDA has seen a jump of 36%, and margin has come in at a multi-quarter high of 20.8%, more than 20% for fourth straight quarter and against 20.2% in the same quarter last year. But one concern is about the outlook. Now company is saying that from the 20% growth that we have seen in Q4, the growth in the near term for the motorcycle segment is going to slow down to 7 to 9%, and that would be mainly because of the sharp increase in the material cost that we have seen over the last few months, and the price hike that company has taken in the month of April has offset the 40% of those hikes, but still it will be impacting the demand in the near term. But I'm going with light green.
Thank you very much for that. Let's talk about Godrej Consumer and how the numbers look. Manglam joins in. Manglam?
Good morning. Going with green on Godrej Consumer because, these numbers are good as expected. The company had given us a preview into what fourth quarter would look like. And this is what it looks like. 11% growth on the revenue, 11% growth on the EBITDA, net profit growing at around 10% as well. Compare that with our poll, 3,900 crores on the top line. The street was working the number of between 39 to 3950 crores. EBITDA at 841 crores. The poll was 840 crores. The net profit at 452 crores looks like it is, a lot below street expectations of 565 crores. But here, there is an exceptional loss of about 92 crores. So if you add that back, The net profit also in line with expectations. 8% volume growth. The range that the street was working with was between 7 to 9%. But more importantly, the reason why I'm going with green is because the company has said that the India business will deliver continued calibrated growth at normative EBITDA margins. And the normative EBITDA margins for the India business are between 24 to 28%. And this despite near-term inflation. If they are maintaining their margin guidance, that's a positive. Indonesia, they expect a meaningful step up in performance. So that's another positive. This, while the Africa and other businesses continue to do well. So going with green on Godrej Consumer.
Right, Mangalam, thanks a lot for that. Well, I'm looking at Shree Cement and the numbers were largely in line because the absolute EBITDA number was almost in line at around 1,250 crores and that's what we were working with. The positive though is that the volumes came in up by close to around 9%, which is the highest volume growth we have seen in the past 9 quarters. And now they're guiding for better volumes in FY27 in comparison to FY26 because FY26 they grew by only 2%, but now they're talking about 10% volume growth, which will actually be better than the industry. Let's see if they can do that because this is a stark contrast in comparison to what they've been doing in the past. The EBITDA per ton as well improved by close to around 200 rupees on a sequential basis, though it's dipped below UltraTech for the first time in the last 3 years because the UltraTech was above the 1,250 rupee odd mark, so a little bit lower. Now, the management says that the pricing gap with UltraTech, well, that's been narrowed and they've achieved that. So the key focus now for them will be on volumes, but we'll also have to track the profitability because will it come at the cost of profitability? Capex guidance has been reduced to around 1,500 crores, which is encouraging because it's low on a year-on-year basis as well. And this is a sign that, the industry could now be looking at profitability. Second big company that is slowing down on Capex after Ambuja Cements. So it's a positive read-through for the sector on the whole. And I'm going with a bit of green on Shree Cement because the volume growth seems to be back for the company. But let's hop across to Mangalam. Mangalam's here to tell us about Meesho, the stock that's been all over the place in the last few trading sessions. Mangalam.
And the results will have you believe that as well, Nigel, because, it's the second quarterly performance since listing. And if you look at the numbers, an interesting set because the revenue growth, no problems there. 47% growth led by 43% growth in, net merchandise value and orders as well. But the EBITDA loss has expanded from 231 crores to close to 255 crores. But the net loss has narrowed from near 1,400 crores to 166 crores. And the reason why that's narrowed is because there was a base, loss of close to around 1,284 crores in the same time last year quarter. What's positive is that the contribution margin decline has been arrested. Quarter on quarter, it's seen an increase from 2.3% to 4%. But then again, what's negative is that the company's been speaking about free cash flow positive. This last 12 months, the free cash flow has actually been a negative 633 crores because the company has been making investments and increasing temporary logistics costs. And they do see headwinds in the next couple of quarters. In light of the recovery that we've seen in the stock from the lows, I'm going with red on Meesho today.
All right, Mangalam, thanks very much for that. That's Meesho in focus. Well, Paytm reported numbers and Home First Finance also in focus. Ananya has got details here. Ananya, morning.
Paytm and Home First delivered their Q4 results yesterday. For Paytm, we can see it is still a recovery quarter for them. The YOY picture looks good, but with softer sequential momentum. The market is now expecting sustainable growth from them. When we look at the numbers, revenue grew 18% YOY and 3% quarter on quarter. EBITDA stood at 132 crore, a sharp turnaround from a loss last year, but declined quarter on quarter from 156 crore. So margin also compressed sequentially to 5.8%. PAT was around 183 crore versus a large loss last year, helped partly by an exceptional gain of 21 crore compared with an exceptional loss of 520 crore in Q4 FY25. Now coming to Home First, they delivered a very strong quarter with AUM growing 25% YOY to nearly 15,900 crore, while disbursements hit an all-time high of 1,572 crore, up 24% YOY. Now net interest income jumped 41% YOY, driving a 43% YOY rise in PAT. Now, asset quality trends were also encouraging with GNPA improving sequentially to 1.8%, while ROA remained at around 4.1% and spread stayed healthy at 5.3%, while cost of borrowing improved 10 basis points sequentially to 7.9%. Now, management highlighted meaningful improvement in early stage delinquencies and maintain a confident outlook of around 25% AUM growth for FY27, backed by branch expansion and AI-led initiatives.
Thank you very much for that. Paytm should be on your radar considering they clocked in a profit this time. Upasana joins in with her take on Blue Star. Morning.
Good morning. Where overall it's been a margin beat, especially in the company's UCP segment. But if we look at the numbers on overall basis, the revenue is down while PAT and EBITDA is above our poll. Now, revenue has seen a flat YOY growth. Both UCP and EMPS reported a flat, nearly about just a 1% revenue growth. And UCP margins came at a record 10.4% versus the Kotak estimates of just about 8% that the street was working with. And this is highest since Q1 FY20. Now, overall, the margins have seen an expansion of nearly about 120 basis points at 8.1%, which is aided by 200 bips in UCP and 490 bips in professional electronics, which has aided the overall margin expansion. Now, coming to the gross margin, they stood at 21.5% due to tight cost control measures and even surge in commodity prices. EBITDA stood at 330 crore with an uptick of 18%. EBITDA margins, as highlighted earlier, stood at 8.1%, while the poll that we were working with was around 6.6%. Adjusted PAT has also seen an uptick of 8%. Now, on a full year basis, the revenue has seen an uptick of 4%. EBITDA margins has seen an uptick of 20 basis points at 7.5%, and PAT has seen a downtick of 11%. So overall, expecting the stock to open in mild green, but might slip into red once the volume growth comes out. The con call is scheduled at 12 p.m. today.
Thank you very much for that. Hexaware also reported their numbers. It's an okay set of numbers, nothing great. The company's top line growth is flat. The company in the prior quarter had alluded that Q1 will be a seasonally weak quarter. There were some unusual one-offs that seems to have played out. So the company's revenue growth is down 0.1% quarter on quarter. Adjusted EBIT margins are flat. The bottom line has seen an improvement, but that's on account of lower tax. On the guidance for this year, calendar year 2026, the company has reiterated the guidance despite the soft start to the year. So revenue growth will be 7.6% and more, which is basically last year's growth number. They're saying it's going to be better than that. And on margins, 13 to 14%. So it's an okay inline set of numbers, nothing great. But Yash joins in now with PB Fintech. Numbers look good, Yash?
Well, Reba, going with green for PB Fintech, but there are three things that one will have to keep in mind. One, what has the company delivered in the fourth quarter? Second, what has the stock done in the same period? And third one, what lies ahead of the company? As far as the first point is concerned, what has the company delivered? Very strong numbers for the fourth quarter, premium growing at about 46%, revenue growing at about 37%, contribution growing at about 42%, margins, contribution margins improving by about 100 basis points, adjusted EBITDA growing at 89%, and PAT, excluding all the exceptional items, that also growing at 53%. That was the first point. The second one, what has the stock done? In the last 1 month itself, the stock is up about 15-17%. So that will have to be taken in consideration. Third thing, what lies ahead? Of course, now with the numbers being delivered on a strong footing for fourth quarter, there are certain overhangs which will come in. The consultation paper on the distribution regulations, as well as what that means for the company, will be a key trigger to watch out for.
Okay, all right. So that is PB Fintech, and stock perhaps higher as we start a trade today. Well, we reported that Arvind Limited is a subsidiary of Arvind is looking to make an acquisition. This was day before yesterday. And that news getting confirmed. Rachna reported that exclusive story. She's with us with the news now. Rachna, morning.
Good morning. Like you said, it is a CNBC-TV18 News break confirmed. Arvind Limited's wholly owned subsidiary, which is Arvind Advanced Materials, will now acquire or has acquired US-based non-wovens needle punch manufacturer, which is Dalco GFT. The deal value is at about $136 million for about 61% of controlling stake, valuing it at about 7.75 times current year 25 EBITDA. This is pretty much in line with what we had reported day before yesterday. Now, speaking of Dalco GFT, the company clocked revenue of about $100 million in current year 25 with EBITDA margins of over 17% and a return on capital of approximately 40%. It operates two plants, one in North Carolina and South Carolina, with 88% sole source positions with leading global OEMs. The deal is a debt finance. Again, this is what we had reported. $50 million of which will come as a debt to the US entity, whereas $60 million to the Indian entity, which is now Arvind Advanced Materials Limited. The company says it is margin and EPS accretive from year one and has defined a path for full ownership within 4 years. So that's today is an investor call at around 2 p.m. by the company, so we will track that as well.
All right, congratulations. So that's Arvind story getting confirmed as we had put out. So almost all of it in line with what we had reported. Well, a quick recap of the top stocks that we've put out on the top 10 list. So stocks with positive news flow are Bajaj, Godrej Consumer Products, Shree Cements, PB Fintech, Paytm, Home First Finance, Blue Star, and of course Arvind as well. But stocks on the other side are Meesho. A bit of a mixed view on Hexaware, as Rima pointed out as well. Manisha is here with a quick roundup of everything from the commodity space. And oil, I'm assuming, has got to be top of mind once again. Big gyrations. Manisha, take it away.
Oh, absolutely, Prashant. Yesterday was one crazy day. 12% of a decline at one point in time. And we did see the crude oil prices decline to 96.70 off a low. From there, the closing came in at 6% lower, and today we are back above $100 a barrel into the markets there. Of course, the Axios report did all the movement yesterday, where we do understand now from both parties that US and Iran are closing in on a one-page memo to end war. And after that, there would be a framework set for a more detailed nuclear negotiations, and the US expects Iran response on several key points in 48 hours. And then if that doesn't happen, US is threatened to resume military strikes. So it still is slightly up in the air, and that's exactly what the crude prices seem to be factoring in as well. Having said that, the U.S. oil exports are at record highs for a second straight week, and we have seen a decline in U.S. inventories as well. But what has the crude's decline and the U.S. dollar going down has made the day for metal prices there. Gold gained 3% overnight. Silver was up 6%. Copper has gained 4% in this week. Well, the decline in U.S. dollar and the fact that the U.S. and China could be meeting next week is something that the markets will focus from here on.
Thank you very much. For that, we will slip into a very short break. We'll come back and get you a discussion around the defense sector with former Defense Secretary and Ashok Atluri of Zen Technology. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. Well, a little over a year has passed since the launch of Operation Sindoor, an offensive that fundamentally altered India's national security doctrine. Hormas is here to decode how the sector and the recent geopolitical developments are reshaping the future of Indian defense. Hormas, take it away.
Over the last 12 months, the emphasis has been, a great emphasis has been laid on defense modernization, defense procurement, and more importantly, domestic defense procurement. And that has now translated into companies getting significant orders and inflated order books as well. Of course, today being a year of Operation Sindoor, and since then, the defense companies in India have been in focus. Look at the Nifty India Defense Index over the last 12 months. It's a 30% up move that the index has seen. Of course, it has come off the highs. It would have been a lot higher at its peak as well. But take a look at the top performers over the last 12 months in the defense index. MTAR Tech has flown away. It's up almost 350% over the last 12 months. Axis Cades is up 180. Apollo Micro has done very well for itself as well. Look at other names like Dynamatic Tech, Data Patterns, Bharat Forge. All of them have seen gains of anywhere between 70 to 90%. But the emphasis was also on the defense PSU companies. And you take a look at Garden Reach Shipbuilders, that has been the outperformer among the defense PSUs. BEL, a nifty entrant now, 40% higher over the last 12 months. But the underperformance has come from Mazagon Dock. The stock is down 11% over the last 12 months, and Bharat Dynamics too has declined 8% over a similar time frame. But what has transpired over the last 12 months? There was greater emphasis laid on the defense sector in this year's budget as well. The budgetary allocations were up 15% from last year, almost nearing 8 lakh crore rupees now. The capex budget increased by 22% as well, and most of that, as I highlighted earlier, was for domestic procurement. That is where the emphasis currently lies, and that has translated into the order books of these companies. Take a look at these figures now. This is as of the third quarter of this year, as most of the others are yet to report numbers for the fourth quarter. HAL has an order book of close to 1.5 lakh crore, BEL close to 77,000 crore rupees, Mazagon Dock, Garden Reach, Cochin Shipyard, the three main shipbuilders also have order books of anywhere close to 80,000 crore rupees combined. There are big orders in the pipeline as well. There are companies that are banking on them. We spoke of Mazagon Dock, that is banking on this Project 75I submarines order. That is one big one in the pipeline. The next generation corvettes order is also in the pipeline. The potential orders for future ready combat vehicles, which put stocks like Bharat Forge, L&T in the spotlight. satellite and the quick reaction surface to air missiles, or the QRSAM. That is one big order that BEL has been banking upon. It was anticipating that to transpire in the last quarter of FY26, mostly now transpiring into the first half of FY27 as well. So there has been a significant emphasis that has been laid on India's defense sector, and that has translated into a significant outperformance from a lot of these stocks as well.
Okay, well, almost interesting data. If you can just quickly put the stocks up on the screen once again, the plate of the stocks which Hormuz put out. Since Operation Sindoor, what have stocks done? I think that'll give you a quick sense of, it'll focus our mind with what's kind of happened. So there you go. MTAR is top of the list there. MTAR, of course, it's not just defense, it's nuclear and it's, space and all of that stuff. And defense, of course, is a part of it. But the others, of course, are... and the list, of course, shows the smaller names doing much better. More focused, a company like Data Patterns into avionics, more niche in that sense. Bharat Forge, of course, is not just defense, but other stuff as well. And now you get to, at the bottom of the list, you get to the pure defense companies. Shipbuilders, of course, have done well. Mazgaon Dog, Bharat Dynamics, HAL has had issues. So some of the larger ones, perhaps over the last 1 year, have underperformed a little bit. We have Giridhar Aramne, former Secretary, Ministry of Defense. He's joining us. Sir, good morning. Good to have you with us here. Thanks for joining us. Prashant this side. One trend we are observing globally, and it's got investment implications, is the shift away. It's not a complete shift away, but basically what matters is where the incremental rupee is being spent. Some stuff you can't avoid. But is the incremental spending happening on things like drones, in a very big way? We are seeing this around the world, in Europe, etc. Companies like Rheinmetall, which, by the way, have joint ventures here in India, pivoting and shifting to, investing in drone capabilities in a very large way, away from just purely focusing on land-based systems. Just your thoughts, sir. This was the lesson from, I think, one of the lessons from Operation Sindoor, drone warfare, and I think what we've seen in the Middle East right now as well.
Good morning, Prashant. Let us start by expressing our gratitude to the air warriors, the sailors, and the soldiers on the anniversary of Operation Sindoor. In fact, Operation Sindoor was a doctrinal shift. It's not just a strike. It shifted entire orbit and doctrine, how the Indian military is going to fight future wars. We are thankful to our forces because they quickly adapted to the new reality and started procuring the necessary equipment and the capabilities. As you pointed out, the entire battlefield has shifted to the aerospace. In fact, the precision, the speed are now governing the entire battlefield. And also the autonomy, which is basically coming through the drones, whether they are the high altitude or medium altitude, or the ground robots or the surface robots in the sea. All these things combine into an ecosystem where the autonomous vehicles, on all the three fronts, are going to be of great use. Indian Army realized this quite early. In fact, the army commanders have been procuring large number of drones of all varieties. And the Defense Ministry also has procured a lot of drones, the high altitude, long endurance drones, which will aid us in surveillance. And also the drones, which are tactical in nature at battalion level and lower level. However, the latest wars in Iran versus Israel and US and Ukraine and Russia have shown that the adaptability of the autonomous systems is going to be of great importance. During the battle, actually the improvisation is taking place. The lessons learned yesterday are being incorporated into today's design and manufacturing of the drones. So
Mr. Armane, if I can ask you, your assessment, right? And there's no real exact number to this. There's no way to do it. But in your assessment, in your experience, out of say 100 rupees spent on, let me put it discretionary, right? Most of the defense expenditure in any budget is fixed. I mean, it goes to salaries, pensions, there is upgradation and all that stuff, but any additional spending, do you think a larger share will go to, aerospace?
Yeah, that is likely, but you should not view it as a single drone kind of a capability. Drones require the sensors. Drones require the seekers. Drones also require the artificial intelligence-enabled systems, embedded systems within their platform. So entire platform of autonomous flying vehicle is going to be of huge importance, and the incremental spending for that is going to be substantial. It may be even 30% if you look at all the combined things. And aircraft as themselves are going to be of a huge expenditure. We are acquiring now Rafael, AMCOM, and the Tejas platforms.
Right.
They are in various stages.
Yeah.
So they will consume a large part of our budget.
Got it. Just last night, I think the US Secretary of Defense is on record that the US military, because I mean, one of the things out of this Iran conflict is very expensive anti-drone missiles being used to shoot down very cheap drones. So it was kind of, so the US essentially saying we want to build something ground up, which costs, I'm not sure, $250,000 is cheap, but I read $250,000, and they want to sort of, ask a company outsource it to build something like that. We have somebody who works in the anti-drone space and has been talking to us about all of this for a while. Ashok Atluri is with us, CMD Zen Technologies. Mr. Atluri, good to have you with us here. So we were just sort of, marking the 1-year anniversary of Operation Sindoor and how this has changed. And the former Defense Secretary, Mr. Aramane, was telling us the focus on aerospace, but it's not just purely drones, but it's the entire ecosystem there. How has the environment changed? And, I was asking Mr. Aramane, out of every 100 rupees incremental spending on defense, how much will go into this area? Just your thoughts here. You're on mute, Mr. Atluri.
First, I would like to, thank the armed forces for what they have done, extraordinary work that they have done, and their leadership within the country. And good morning, Armane sir. How are you? I hope you're doing well. So yeah, so my thinking is that as the point that you raised, for a $30,000 drone being sent, a Shahed drone being sent, they are sending missiles which are $3 million. So the missile math is absolutely, 100x, how you will definitely be depleted. The only way to handle the drone threat, in addition, of course, what we have supplied to the armed forces, the anti-drone system, which was used effectively, because the software jamming was is the beginning. But now what is happening is the drones are becoming autonomous. They're autonomous, so they don't even need the, sometimes they don't even need the GPS signal to come to a point. They have something called as vision-based AI. Vision-based AI. Vision-based AI is there that can actually go to the destination. So that the problem is that we are not able to exactly tackle the threats that with the existing thing. So we have to build something new, which are very, very reasonable and cheap. So recently in the North Tech Symposium, we launched anti-drone, the interceptor drone that we are saying will cost something in the sub $10,000 range. So if you actually neutralize a 30,000 drone with a 10,000 interceptor drone, and this can go up to a speed of 400 kilometers, so things will really be good. I think that is the math that we have to handle. Again, a lot of things are shifting, but this is the point I would like to start first.
But Mr. Atluri, so you all have launched this interceptor drone, right?
That is right, yes.
And laser-based DEW as well, direct weapons, I believe.
Yeah, so we also launched and we demonstrated it at a range of 1 kilometer that, at multiple targets we could take out at, with a 2-second interview with the thing. So laser thing was also launched, and this was actually demonstrated. So there is a lot of excitement about that to intercept a drone. The other thing we launched was a self-contained anti-drone system. I mean, it was just a radar-based. People who don't want the detector, jammer, and all that. There is a self-contained with the ground weapon stations. So that is also was launched. So we are pretty excited about the thing that I think we are going to launch again, completely focused toward the future wars, not the past wars. So that is one thing that we feel very excited about. Yeah.
All right, Mr. Atluri, we take that point on board, but since we haven't spoken to you, post your results, and there was a couple of one-offs in the past quarter, just wanted to quickly revise the guidance for this year. Your order book, I think, is 1,300 crores, but you're guiding for a big order inflow in this year. Could you tell us what is the order inflow likely to look like? You're guiding, I think, for 4,000 crores of revenues over the next 2 years, but in the near term, what could it look like? And margins. 3 numbers, sir.
So, the margins will continue at, 35% EBITDA. We hope that will continue in spite of our extremely increased R&D expenditure that's going to happen. The second thing is the order flow. Again, we have been saying that in the cumulatively will be 4,000 crores. We think that the order flow will start in the, we in fact, we're expecting something this quarter. Something may happen during this quarter, but not later than the next, next quarter. I think it should be there in the next few weeks. So the third thing is that, we expect the order book, once it builds up during this quarter, I think the almost 1,000 crores we expect to be executed in the first 3 quarters, and the remaining will be executed. I think the new orders that will come will account for the 4th quarter. And we think that by the end of this financial year, the order book will be substantially higher, which will give us visibility of the execution in the FY28.
Armani, just getting back to the point, sir, that we started with. Now, when we look at India's budget, the defense outlay, it stands at about 2.116 lakh crore for the coming year. What percentage of that would be spent on drones and anti-drones right now? And, since, as you said, right, drones have become the new battlefield. Say 5 years down the line, how much would the number go up to? And what's the breakup currently between indigenously produced drones and how much are we importing?
Frankly, the government is very, very flexible. They don't have this kind of a thing that, they've come up with a budget and they'll stick to that thing. So we can see what was being talked about 1 year, 2 years back. It's completely becoming irrelevant. The focus has become anti-drone system. We think that they're going to buy at least a couple of $1 billion worth of anti-drone systems, and there'll be a lot of investment in drone. Again, the investment will be in the drones will be in such a way that they are also building. The government is also focused on building capabilities in the drone facility, in the drone facilities within the country. And what is the point of that is, in case of a full-fledged war, suppose we expend something like 30,000, 40,000 drones a day, that our replacement should be as much as that, 30,000, 40,000. So we need to build those capacities within the country, and government is going in that direction. And I think we will be again, the government is supporting. So to your question, yes, the budget is moving towards that, and most of the drones they are saying is going to be indigenous, except for the Predator kind of drones that are even those are being built now by the Indian.
There are that male drones, right? Medium altitude drones, which are like Predator drones. So they're being tested, etc. Mr. Aramne, just one thing on the point about indigenous manufacturing and just sticking with drones for a bit. Sorry, this entire discussion has been taken over by drones, but I think that is where the future of warfare is moving. The import of drones is banned, right? But import of materials to manufacture drones, assembled drones, is not. So there is a bit of will the government change it once there is enough capability?
Yeah, see, drones means different things. The composites and the metal required for the airframe is an important one. Carbon fiber and other composites we produce in limited quantities, so import of that is going to be of great importance. Similarly, several propulsion systems and batteries are not available right now in the country. So those things will have to be imported into the country. And certain type of seekers, although we are in very advanced status of manufacturing within the country, certain types, very small number, have to be imported. But overall, a drone with its electronics manufactured outside the country is banned. We have taken several measures earlier also to ensure that the Chinese drones do not enter or military service.
Yes. Well, I could go on. Lots of other interesting avenues we could go and take this discussion into. But for now, thank you very much both for joining us. And I think as both of you express gratitude to the armed forces for what they've done, what they continue to do. And I think that is, of course, our feelings here at CNBC TV18 as well. Mr. Aramne and Mr. Atluri, thank you for being here on the program. Well, let's just take a quick commercial break here. Devin Choksi will be joining us for some fundamental stock conversation. We have our trades coming up as well with Sudarshan and Mitesh. 10 minutes to go for the pre-open session.
Welcome back. Well, let's focus on a couple of stocks and get some fundamental advice going. We have Devin Choksi, MD of DR Choksi FinServ, who joins us on the show. Hi, Devin. Good morning. Good to see you, Ben. Devin, in terms of stocks from the defense pack, what's on your preferred list?
Good morning. Well, I think the companies like Zen Technology, for that matter, or even I think within the defense space, DCX, I think, which is the other day, I think, a sizably large amount of the order for the radar. I believe that I think some of these companies are actually growing with a larger amount of government's allocation towards the defense side. And at the same time, I think the growth rate that they are assuming is probably, I think, double or more than double the size of the growth in the economy. Some of these companies are executing at the pace of around 25 to 30% rate of execution rate against the order book that they are having. So which is giving a good amount of visibility for the businesses, I think, which we are talking about. In my viewpoint, I think the market is already priced to perfection as far as I think some of these companies are concerned. So no immediate opportunity that one can latch on to. However, if one is interested in looking at, I think, long term for next 2 years, 2-3 years, then some of these companies are definitely available at current price, and maybe I think in falling market, better opportunities come along.
So Zentech and DCX, is it? Zentech and DCX, is it, Devin?
Yes, Nigel. It's Zen Technology and DCX Systems, yeah.
Okay, all right, got that. Devin, yesterday, you had the entire financial pack actually that came alive. And that's good because that was going through a little bit of a period of underperformance. But what's even more encouraging is the kind of numbers you're getting from NBFCs. The growth is good and appears asset quality is pretty okay, at least as of now. From the BFSI basket, what's in your preferred list?
Well, I guess I think most of the companies in the fourth quarter result, as we have seen, have got one unique, disclosure, which is their non-performing asset provision has significantly come down to what their previous high was. And that's a very good sign because I think most of these companies are probably, I think, finding the benefit of the lower interest regime. At the same time, I think the healthier economy at this point of time in recovering their dues. So it's a very good sign. And I believe that I think that journey could continue for some of the companies systematically. We definitely like the franchises which are retail-oriented franchises, particularly in NBFC as well as in the private sector banks. We are not so very comfortable with the MFI space where the valuation still remains at a high level on price-to-book value basis. Vis-a-vis that, we find that I think the larger banks and larger NBFCs are currently quoting at a valuation which are corrected and probably giving an opportunity. So yes, we are looking at 15 to 20% kind of an upside in some of these companies 1 year forward basis, as far as I think the price outlook is concerned.
Okay, all right. Let's talk about some earnings reactions. Then we had Godrej Consumer that came out with its set of numbers, and some of these FMCG names are actually delivering good numbers, and they're surprising positively. On Godrej Consumer, the numbers look pretty much in line, double-digit top-line growth, EBITDA growth as well. But the volume number was a tad bit better than what the street was working with, approximately 8%. Any view on this name? And we've had a couple of good earnings actually coming in from the pack, starting off with Nestle, then we had Marico, and Godrej Consumer doesn't look too bad as well. Some of them, though, we already had a cheat sheet. Your view on this name, and do you like it?
Yes, I think in FMCG space, a couple of quick observations. Likes of Unilever, likes of Nestle, even I think the mid-tier FMCG companies are categorically reporting that I think their order intake from the e-commerce side has started increasing. In fact, I think when you look at likes of Unilever, Hindustan Unilever, I think their ONDC platform contribution in the business has started, increasing systematically. So now that gives us two or three main points. A, I think they are actually creating the digital reach to the end consumer. Second, using the AI in their logistic management systems and demand generation systems. Probably some of these companies are reporting better than the expected numbers in form of margins as well. So we believe that that trend is likely to accelerate, it will continue. And the bigger beneficiaries would be some of the larger companies which are adopting this tech in a very systematic manner. Though they are priced adequately at this point of time, but do believe that the larger FMCG companies have relatively better thing to offer. So we may expect that 15 to 20% kind of an up move in a good market is distinctly possible in these names. Maybe with some caveat that in this quarter you might see some pressure because of the cost in their input, but I think the volume would probably take care of that cost pressure. So we believe that any correction in the price could become a good opportunity for some of the larger FMCG companies to buy into the portfolio.
Brilliant, Deven. Appreciate you joining in. Thanks for giving us your quick insight on all of these names. Wishing you a good day ahead, and we catch up soon. Thanks for joining in.
Good night.
Well, time to slip into a short break. You come back, we'll get you pre-open rates. We'll also be joined by Mangesh Badang, who will be giving us his insight into Shree Cement's numbers, as well as how he sees the cement pack shaping up from here on. Stay with us.
Okay, welcome back. I think Mitesh is with us, and so is Sudarshan with what they'd want you to do as far as trades are concerned. There's 15 minutes to go for the market open, and I think we are just about starting the pre-open session. Sudarshan, good morning. You go first. What's the strategy?
Yeah, good morning. Well, I'm very pleased. For the last 3 days, I've been saying go long, buy every day, buy the open. The markets have finally rewarded us. Now we are at the verge of a very strong resistance level. So the Nifty may pause here, but the trend remains up. So my suggestion is if you have long positions, take profits on half. We had a very handsome 300-point rally and keep the other half with a stop above around 24,000. Raise it to 24,000. If you do not have any long positions, look for small corrections and dips to buy. The same stops 24,000. Now there is a very big geopolitical news event, so anything can happen. But even on if assuming there's a sharp dip, we should be buyers.
Got it. Sharp dip, we can be buyers. That was the call yesterday, and that worked out as well. Mitesh, what about you? Yesterday we had a good rally. Today the GIFT 50 is suggesting a flattish to a mildly negative start. How would you trade the Nifty, and more importantly the Nifty Bank? Because after a while that's gone ahead and at least conquered the simple daily moving averages. Yesterday it took out the 20 DMA and it went to around the 50 DMA.
I think good morning, both the indices, kind of managed to get past their 10, 20, 30-day averages. And on the Nifty, I've highlighted 24,350 to about 24,400 as the key level. I think today we'll open around that. If we start getting past 24,400, I think I'll maintain and extend long position of stock, but also explore some longs on the Nifty. So basically the idea is that either you buy about 24,400 or if you get a decline as Sudarshan said, that'll be an entry point. So for the time, trading with a positive bias and about 24,400, 24,650, 700 looks to be the next short-term resistance.
Got it. All right. Let's get some calls going then. Mitesh, start off with you. What's top of the list?
I have buy calls today starting from Bajaj Auto, which is a buy with a stop below 10,000 for a target of 10,450. Then Biocon, in fact, the entire pharma pack did well, and Biocon is a buy with a stop at 370 for targets of 400. A buy on DLF after a long time, recommend buying here with a stop at 599, 598 for a target of 630. And amongst the Bajaj Twins, Bajaj Finserv is today a recommendation. Keep a stop at 1810, look for targets of 1885.
Got it. Okay, all right. Thanks, Mitesh, for that. Sudarshan, what about you? Individual stock calls?
Well, I have M&M, buy M&M with a stop under 32.30. NAM India, buy with a stop under 1070. Hind Petro is a buy with a stop under 390. I have one short sell, that is Suzlon, with a stop above 55.
Okay, got that. What about the big boy, Reliance Industries? That's actually been leading, holding one end up. Any view on that name?
I have that consistent view that Reliance is a positional buy, not an intraday or short-term trade. Every dip in Reliance remains a buying opportunity, but that's for months and years, not for days.
Okay, and if you have to, when does this view get negated? On the downside, I mean, what kind of support are you looking at?
For Reliance?
Yes.
I don't get negative on Reliance because that means getting negative on the Nifty. Right now,
Right.
I'm positive on the Nifty.
Okay, got that. Thanks a lot, gentlemen, for joining in. And we noted your calls, Sudarshan, as well as Mitesh Ashri. You'll be indicating if there's an intraday dip, look to get in, and that worked out perfectly. So our viewers as well would have taken note of that call. Thanks for joining in. We'll come back to you all at 9:10. Well, let's focus then on, I think we have Mangesh Badang, who's joining us now to help us out with a quick analysis. All right, I think before we do that, let's just quickly revise Shree Cement's numbers. The numbers were more or less in line. EBITDA number at around 1,250 crores. That was bang in line with what our poll threw up. The encouraging part was the volumes grew by close to 9%, which is the highest volume growth we've seen in 9 quarters. And remember, now the management seems to be focusing on volume growth because in the past they grew by only 2%. The volumes for FY26 were up 2%. For FY27, they're guiding for a volume growth of close to around 10%. So that's encouraging. Focus shifts to volume growth. The EBITDA per ton as well improved by 200 rupees per ton. That's on a sequential basis. Though it was a little bit lower than what Ultratech reported at around 1,200, 1,250 rupees. And that's the first time that Shree Cement's EBITDA per ton is lower than Ultratech Cement in the last 3 years or so. Now, the Shree Cement management says that the pricing gap with Ultratech Cement, that's been narrowed. Now they'll be focusing more on volumes. Though the profitability is something that we'll have to track closely. The capex guidance as well has been cut to around 1,500 crores in FY27. That's lower than the previous year and even prior to that. So clearly, there's another sign that the industry is slowly focusing on slowing down capex and focusing on profitability. This is the second company after Ambuja Cements that's indicated that. So if you have two big names that are going to be focusing more on profitability rather than volumes, it could be a positive read-through for the industry because you'll have less amount of cement that will be pushed out, in turn supports prices and in turn supports profitability as well. To help us out with a quick analysis on that though, we're joined by Mangesh Badang, who's now a fund manager at Avasya Capital. Hi Mangesh, good morning, good to see you win and congratulations on your new avatar. You're someone who's been tracking the cement pack for very, very long. Before we get to Shree Cement's numbers, what do you make of this commentary? The big boys, both Ambuja as well as Shree Cement, they are talking about going slow on the capacity addition. And Ambuja in particular, which was the recent new entrant, they are talking about focusing on profitability. How encouraging is this for the industry per se?
Hi, Nigel. Thanks for having me. So I hope this would have been very encouraging for the industry because we have seen in the past that the number of players in the industry tend to actually overcrowd the profitability, and what we have seen is that of late the numbers have actually not been up to the mark. And barring Ultratech, I think if you look at the performance of all cement companies over the last 5 years, I think Ultratech is a standout player in terms of performance, both in terms of volumes, pricing, as well as profitability. And most of the other players have lagged. If you look at Shree Cement, I think the performance over the last 5 years has not been that encouraging. In fact, it has been faltering. And same has been the case with Ambuja. We've had hopes that, after the acquisition, probably the numbers would change. But the recent quarter's results have suggested that, basically otherwise. So obviously, there will come a point wherein most of the players will start focusing on profitability. But as long as your industry leader is still delivering 1,250 kind of EBITDA per ton, I think the rest have to pull up their plants rather than looking at just focusing on profitability or volume. So it was long due, and I think it has finally come up.
All right, but how do you approach the space then? The big boy Ultratech Cement, what a performer, right, Mangesh? Everyone thought new player coming in there that they'll be challenging the big boy. In fact, Ultratech's best performance has come in post another strong competitor coming in from the domestic market. And they've done inorganic growth and they're ramping up those plants as well. Would you stick to the big boy? I had a chat with Mr. K.M. Bidla and he sounded very, very optimistic on the outlook from here on. He also compared it with their kind of efficiency that before the Durandar movie gets over, they are delivering the cement order, which is encouraging in itself. Will you stick to the big boy or do you believe you'll rather look at some of these names, Ambuja or Shree?
So Nigel, I did some very small exercise, basically just to look at the kind of return cement companies have given over the last, say, 10 years, 5 years, or even 15 years. And again, you will find that Ultratech is a standout performer and the rest like the Shree, even Ramco or even Ambuja, they have not delivered any returns. So it's a clear signal that, when it comes to both volume growth, profitability, as well as best realization, Ultratech is a standout performer. And then even if you look at the smaller companies with the valuation gap, over a longer period, you'll find that Ultratech has been the best performer. And I think probably that's the way to play the sector, in my opinion, rather than chasing, say, low valuation. Or probably certain regions could do really well from now on, which can be looked at. So like East is something that we are looking at, but obviously we're not finding too many players which can actually fit the bill in terms of playing that region. So I think Ultratech is the one.
Yeah. What about East and South? Because you have, you'll have new governments that are coming in there. And the hope is at least the West Bengal, will see a renewed industrial activity and a lot of focus in terms of development. How do you play that? One feedback that I got is normally there's a lot of cement that's dumped from one state to the other. At least that will stop, because a bit of oversupply is in some of those neighboring states, maybe in Orissa and West Bengal, and then you look at the South. So how do you see that playing out? Would you play a theme of the East and South?
So Nigel, we did some channel checks recently, in fact, after the elections as well. And we found that, it's going to take some time for volume recovery to happen. And, meaningful demand to step in within these states. So I would, and currently, basically the indicators are that we are not seeing the pricing discipline that needs to be there in these industries right now. So I think I'll wait for some time before that pricing discipline comes back or the demand recovery happens in those states rather than jumping the gun right now.
Okay, final question on Shree Cement. You mentioned that many of these other names haven't given returns. But if I had excluded the last 5 years, then Shree Cement did well. And then unfortunately, they lost their way a little bit. And we've been coaxing Mr. Bangur as well to ask what he's going to do next. Your view on Shree Cement, one of those big outperformers that went into a slump, lack of, inorganic growth, lack of utilization of the cash in the books, more than $1 billion. What's your view now? They seem to have pivoted towards volumes.
Yeah, so there has been a lot of pivoting in my opinion. So if I have to look at Shree Cement's volume growth that they had looked at in the past, plus the pricing that still is there. So channel check suggests, you mentioned that they have closed the gap, but our channel check suggests that the gap still maintains. So it's, I think, they have improved their efficiency. See, it has always been a company wherein we have seen that the profitability is always the best. So they do really well in terms of managing the costs, and they are trying to actually get that premium pricing. But I think that that's going to take some time. And market was rewarding the company with very good valuation in the past. And since we started seeing volume growth being lower than industry, I think that's when the valuation de-rating started happening. So I think I'll wait for the volumes to start growing above industry growth for Shree on a consistent basis. I think last quarter was very good at 9% kind of growth. So when it is consistent, I think we will start looking at it in a positive way.
Thanks a lot, Mangesh, for joining in and giving us your insight on that front.
Well, I think the news coming through, Nigel, at the bottom of the screen, and we should just pull that up. It just appeared. IIFL Capital, which is the capital market subsidiary of the IIFL Group, is issuing 6 crore shares, almost 5.7 to be precise, equity shares at 350 odd rupees to Fairfax on a preferential basis I mean, we had reported on this back in October of 2025 that there is a deal brewing. Since then, at least a few times when the IIFL promoter has been on the air with us, Nirmal Jain, we've asked him whether something is imminent. And of course, I mean, I think, maybe nothing was, but we didn't get a confirmation. But it's a story we put out many months ago. And I think now this is happening. We'll just look at what this is as a percentage of their equity and what this is. But this is a large player, financial services focused player coming through into IIFL capital out there. We should actually put out an alert as well with regards to that. So 335 on IIFL capital and the deal happening at about 350 or so. So this is a pref issue. Sudarshan and Mitesh are back with us. Sudarshan, what do you have in terms of 9-10 trades?
It's M&M, buy M&M with a stop under 32.30.
And Mitesh, what about you?
I'll go with the buy on Biocon for targets of 400 and a stop below 370.
Okay, we'll come back to you. For now, let's talk about Bajaj Auto. May open up in the green. Good numbers. There's buyback, dividends. Sudarshan joins it with what you need to know.
It was a strong showing by Bajaj Auto in Q4 FY26. And what has worked more for Bajaj Auto is the export. It forms almost 50% to its total volumes. And export has been seeing a strong growth, both two-wheelers and three-wheelers. Three-wheelers had seen an export growth of almost 40% in Q4 FY26. And even two-wheelers had seen a growth almost in the similar range. And that have helped the revenue strongly. And that's the reason you are seeing an uptick of almost 32% revenue on YOY basis. Another positive part was the Forex rupee depreciation against US dollar. That has also added the margin. And in resultant, margin has come in at multi-quarter high of 20.8%, an improvement of almost 60 basis points and even higher against our expectations. Realization, the price hike that company had announced in the month of April and also in Q4 FY26, that has helped realization improve and also to offset to a certain extent of the commodity cost increase that we have seen. So realization has improved 6% YOY and 3% on a sequential basis. But the problem, or say minor concern, is the going forward. In Q4 FY26, motorcycle growth was 20%. Company is saying that it might moderate to 7 to 9%. So we'll have to see how does company plan to offset the commodity price increase that has been continuing for the last few months, and also what's the outlook on export front. But as far as the earnings for Q4 are concerned, it's been very strong and all-round beat.
Okay, all right. So thank you very much for that. And by the way, the management will join us in a bit from now. That is the Bajaj numbers coming through. So thank you. Well, I think the first rates are coming up on our screens. We'll just quickly look at the rates. 24,396, 24,400 on the Nifty, about a quarter higher. The Nifty Bank is up 0.1%. The sensex is up 0.2. Small cap index is up 0.6. And the mid cap index is coming up as well, about 0.5% higher, 61,620 on the mid-cap index there. So that's the picture. Nifty heat map comes up on your screen, gives you a sense of where we are starting. And coming up there now, Bajaj is the number one gainer, as Sud was pointing out. Ultratech, Axis Bank, Trend are all up. On the downside, Grasim, Kotak, HUL are some of the losers which are coming through. But this is, I mean, the initial first rates, and lots of these mid-cap movers, Polycab and Paytm and others are opening up in the green as well. Rima.
Well, building on the momentum, the rally that we had in the second half of the trading session yesterday, the Nifty low was 24,000. By close, we had conquered 24,300. And today, we're pushing towards that 24,400 mark. It's in the green now. The gains aren't a lot, but there is positive momentum. 40 points up on the Nifty. Mid-cap index is outperforming. The mid-cap index is up nearly 0.5%, and the small cap index too up a similar amount, and that's giving us a positive advance decline ratio to begin trade with. 1750 stocks on BSE advancing for about 500 stocks currently in the red. The Nifty Bank opened flat with a positive bias, has now dipped into the red, so pretty flat on the Nifty Bank. But PSU banks are holding up well. So the Nifty PSU banking index has got a gain of about 0.7%, with State Bank of India leading the up move, and Nifty Auto Index is higher, 0.6%. And then we should pull up a Bajaj Auto. Bajaj Auto was up a lot. It was up about 2% in the opening tick. Now it's moderated its gains to about 0.5%. There is that commodity inflation which could hurt the company. Cost pressures. The company spoke about 350 to 400 basis points of cost pressures in Q1. M&M is the other mover that's up nearly 0.7%. It's had a good week so far, a 7.5% rally for M&M post the numbers this week. So the top gainer right now is HDFC Life, that's up 1. Eternal, Trent, Ultratech Cement are some of the other movers on the way down. Power Grid, Kotak Mahindra Bank, Dr. Reddy's, HUL, ONGC, some of the drags today.
Just a couple of quick stocks to highlight. Apcotex Industries, the stock is locked up close to around 20%. It got some institutional holding recalled recently. ICICI Prudential Small Cap Fund had gradually built a position out there. 1.5% I think is what they hold in the company. Apcotex, that's locked up close to around 20% as we speak. The other one is Nitco. Nitco is higher in trade because Matthew Syriac had bought close to around, I think, 20 lakh shares overnight. So explains why that stock is running away in today's trading session. You have R Systems, that's up and about in today's trade. So big move coming in out there. Vimta Laboratories, that's another stock that declared its numbers. The street likes it. Stock is flying away as we speak. Inorganic growth from Arvind, stock up 6.5%. So quite a few movers from the broader markets. Apcotex, I think we'll just try the management. I'm not sure whether or not they do speak to media, but that stock is doing well. And Raymond Realty, another stock that yesterday was up 20%. Today it's up another 7.5%. So the market's taking note of numbers they like and bidding up those stocks.
Well, I think Manish Gundwani is now with us to take some questions around markets. Markets, of course, entering flat zone. Manish, great to have you with us here. Manish is head of equity, Bandhan Asset Management Company. Do we need help from this US-Iran resolution, or markets will do just fine even without it, Manish? On a lighter note, because they're doing just fine.
No, I think we should not be too complacent. I think it's obviously got a big impact. $100 oil, we may have got used to it, seeing it for last 2 months, but we should remember fiscal current account will come under a lot of stress if it sustains. So I do think the domestic economy will get impacted. I think obviously what is helping globally is that the dollar has been surprisingly weak in a macro crisis, which is why liquidity is good. The EM markets are doing well. And obviously domestic liquidity is good as well. But we should not be too complacent around this war. If it sustains for maybe a couple more months, I think it will impact a lot of our macro stability.
Manish, today is 1 year to the Operation Sindoor. We had the former defense secretary with us earlier in the morning. We had a management of a defense company as well. Give us the investor perspective here as far as defense as a theme is concerned. We had a table up looking at what stocks have done. Of course, it's like this 1 year time frame because it's 1 year to the operation. And it's basically niche players which have done quite well. Smaller niche players in the aerospace, avionics, a name like MTAR, which is not just in defense, but space and other areas as well, nuclear, etc. as well. So it's more niche now. Some of the bigger players, which do, your BELs is definitely done a little better. Shipbuilders perhaps, but, your HALs and the and the others, they've kind of lagged a little bit. So what are your picks here in terms of how you think about the space?
So it's one of those spaces where the top down is very good, but honestly, as you said, the larger names have the issue that since they are PSUs and they're basically catering to one client, I think margin outlook is very uncertain because if the fiscal situation gets under a bit of stress because of the oil prices, there could be a case where the government might squeeze margins for these defense PSUs. There are other issues as well in terms of execution and all that, the supply chain issues from Middle East. But I think the bigger question at the back of investors' mind is the margins for some of these companies have been higher than at some points in the past. Now, whether that will sustain or not. So I think that's why people are looking beyond the bigger names, which tend to be PSUs. And I think you have to also remember that globally, there is a good CapEx cycle going. One is defense. One other bigger one is, of course, the AI CapEx, the data center CapEx. And now I think there is a reasonable case to be made that we will see oil and gas CapEx pick up too once the war subsides, because there will be reconstruction of facilities, and this energy security obviously is going to move to the center of agenda of politics. So I think some of the smaller names which you mentioned and others which cater to a mix of defense, oil and gas. I think they are a very interesting place to look at.
Manish, hi, morning. So if the war ends soon and crude prices hover, settle between $90 to $100 per barrel, do you think markets have priced in the macro, the expected earnings pressure at this juncture?
Yeah, I think if it remains above 90, I don't see too much upside on the domestic stocks like banks, autos, etc. Because 90 is also not great. I mean, we used to be at 60, right? And I think the issue is not only the Iran war. I think the biggest issue for the Indian market is actually AI, because the whole world is trying to invest in that mega theme. So whether it is the Max 7 in US or Samsung, SK Hynix, TSMC in the emerging markets. And the AI theme now broadening, where apart from the direct players, you have electrification players and now even commodities. So if you see Brazil, South Africa, those markets have also started doing well. The currencies have actually done very well because obviously copper, oil prices are good. So I think the competition for capital for India is very, very strong at this point of time. I know it's a momentum trade. At some point, this AI thing will either land softly or explode, implode, whatever. But until that happens, it's very difficult to see foreign investors becoming super excited about India, because India continues to be a steady story. There's no big acceleration in earnings. There's no AI play. So there's not too much of excitement versus Korea, Taiwan, Brazil, South Africa at this point of time.
What's the one sector you're most bullish on at this juncture?
In terms of sectors,
yes.
We're basically looking at manufacturing exporters, because we believe that if IT services slows down for India, we will need policy support and we will get a tailwind from currency for the next biggest exports, which is manufacturing exports, right from pharma to engineering to auto anchors, etc. I think that's a good space to be.
And everyone's talking about energy security. You also spoke about some policy reform is perhaps imminent. Do you expect something to come through as early as this fiscal year? If yes, in what form and shape? And therefore, what would be the investment play ahead of that, anticipating this?
So I think a lot of the capital good companies or engineering companies which provide good for oil and gas, power, defense, they're good players. I think when you look at energy security, I think each country will try to honestly give up on ESG as a priority and move to security as the first point on the agenda. So for India, for example, I think there'll be some initiatives in coal to gas, because we have coal. And we've seen this recent experience that it's because Qatar's plant is closed down, how much pressure is there on the LPG situation. Now, obviously, countries will not want to repeat this experience. There are some countries which are short of refining capacity. I think they will think hard. Do you want to be short of refining capacity? Because if the countries which are surplus start banning export of diesel and petrol, then how do you survive? So I think there'll be a lot of these questions where everyone will look at nuclear, they look at coal, they look at solar. And I think people will try to, or countries will try to build in a lot of redundancy. So you don't want just-in-time kind of supply chain, because we've seen with Ukraine and now with Iran that if you just have a very fragile supply chain, how difficult it is when energy shortage is there.
Manish, thank you very much for joining in. Helpful conversation. Always great chatting with you.
Thank you.
Thank you. Let's get to a CNBC-TV18 exclusive now. Coforge reported a good set of Q4 numbers. Stock rallied sharply yesterday. Margins came in at record level, 16.6%. Sudhir Singh, CEO of Coforge, is now joining in. Mr. Singh, morning. This is Rima here. Let me get to your margin guidance. You are guiding for margins of 20.5 to 21% next year, which is basically about a 200 basis points margin expansion. Now, you've outlined a couple of factors driving this. The Encora synergies, you will cut down on cost. But how much of that 200 basis point margin expansion upgrade is on account of AI, internal AI usage, and better pricing because of AI?
Most of it is on account of the AI interventions, the automation that we're driving through the entire function space that we have. One of the biggest things that we've done outside the results for the year that we've announced over the last 12 months has been the fact that we have made ourselves in many ways client zero when it comes to driving automation and AI-based interjections across the organization. So when we gave a guidance day before on the investor call of jumping by more than 200 bips, that's guidance where, given everything that's been done, we feel that that's a number that we believe we will hit very solidly, and we will hit for sure.
So you're saying most of the margin upgrade is on account of AI-related factors, right? Of this 200 basis points. So should we say 100, 150 basis?
Yeah. And let me just be very clear about that. AI-based interventions across our own internal operations. What we've decided to do is to make sure that the absolute G&A cost stays exactly where it is. We don't allow the absolute cost to go up despite the considerable scaling that we expect to see on the revenue front ahead of us.
Sudhir, hi. Good morning. Thanks for joining us, and congratulations. Good set. It's rare to see an IT services company raising guidance and sounding as optimistic as you are in the overall IT services set. Now, having said that, Sudhir, just a basic question, because the numbers are well known, and we'll talk about some of the numbers in greater detail. But is the way forward set in that way? This is what these AI foundational models can do. This is where IT services companies can come in. Is the playbook, the framework, so to speak, do we have that playbook now from your perspective? Or you think that itself is still evolving? Anthropic, for example, I think over the last 24 hours introduced a suite of products for financial services, banking. You must be well aware. So I'm just trying to understand, is that relationship set in terms of how this will work?
The frame, Nigel, is set, and there are obviously going to be advancements that happen on the LLM front. Prashant, hi, my apologies. There are going to be changes, Prashant, when it comes to the LLM set. There are going to be changes and developments, as is natural, when it comes to the tool sets. But as far as the services layer, the integration layer is concerned, to your immediate question, the frame is absolutely set. For firms and teams that focus on labor as a default, growth is going to be increasingly hard to come by, because that's not the value pool that is going to expand. The value pool that is going to expand and is already expanding is for firms and teams that can focus on AI native process redesign, that can focus on creating delivery models that also have domain enabled agents imbued in them. For firms and for teams, again, that can actually help enterprises with what they need, which is creating AI ready data pipelines. So the frame, again, to your immediate question, for services firms in the integration layer, in the solution construction layer where we are, is set. While there will be changes, there will be continued advancements when it comes to foundational models or when it comes to the tools that surround the broader AI space.
Sudhir, you said you're planning to keep your G&A cost unchanged, even as the company continues to grow very fast. What does that mean in terms of your headcount addition plans? And if AI is going to continuously drive this kind of productivity and interventions at the cost level and at the revenue level, do you think your margins can be on a structural uptrend? I'm not asking for an FY28 guidance on margins, but just asking the direction. FY27 you've outlined, it goes up, minimum 200 basis points. But do you think there is a structural uptrend to margins given the AI-related factors?
And the short answer is yes. If we can drink our own Kool-Aid, which we should, if we're going out there in the market as a tech services firm talking about AI enabling enterprises, we have to be client zero ourselves, for ourselves. So the guidance that we've given for 20.5 to 21% EBITDA for FY27 is a guidance that will be beat for sure and has to be beat in FY28.
So 27 expansion, 28 expansion as well, right? Margins continue to expand into 28.
They will. They absolutely will. I'm not sure if it's Prashant or Nigel on the other side, but yes, they will.
Prashant here so far, but Nigel will come in as well. Right. Yeah.
All right. Okay, so that's about margins, Sudhir. What about on the free cash flow side? Now, you have upped your guidance. Earlier, it was 70 to 80%, free cash flow as a percentage of PAT. Now, you've upped it to 100. What's gone behind this upgrade?
I think we're looking at what we've already achieved in Q4. Our normalized free cash flow to PAT has come in at 150%. The guidance going forward for next year that we've offered is only 100%. What we've done over the last 12 months in particular, one is what I talked about, AI interjections at scale within our operations. The second thing that we've done is we've approached the entire cost structure very closely to make sure that the FCF to PAT ratio goes up. We hit 150% in Q4. We think 100% is the least that we should aim for and the minimum that we will deliver going forward.
And on travel and BFS, on travel, because it's one of your large verticals, it was a significant contributor to your growth last year. There is concern on account of the Middle East crisis. Have any of your customers, clients paused projects or they're rethinking the planned ramp up? And even on BFS, that was the only major vertical which actually declined in the quarter gone by. If you could tell us the reason and the growth outlook.
Sure. I mean, if you look at travel in FY26, the year that's closed, we grew more than 70%. Banking, we grew more than 12%. I suspect, given the long-term, the secular tailwinds that travel has because of the one order, one offer-led transformation that's happening, and because of the airport redesign as retail malls on an ongoing basis, travel is likely to be one of the fastest growing verticals for Coforge in FY27 as well. Banking again should do better than the 12% growth that we delivered in FY26.
Hi Sudhir, this is Nigel on this side. I need to ask you one question before we let you go. Over the last many quarters, we have been pushing you. When will you go to that annualized run rate of $1.5 billion, $2 billion? Now you're already doing a pro forma revenue of close to $2.5 billion if I include Encora. So, ye dil mange more, right? When do you get to around $3 billion? Nomura, in their note this morning, they are talking about $3 billion in FY28. That should be the target, $3 billion by March 2028?
We'll get there very soon, Nigel. Last 9 years, we've grown at a CAGR of more than 21%, and for the last 9 years, our PAT has grown at a CAGR of more than 24%. That's not a track record that any IT services firm over the last decade can come even close to. I totally agree with you. Ye dil mange more, and ye dil mange more bahut jaldi more. We should be hitting, hopefully by the time we have this conversation, same time next year.
Okay.
So we should be having a conversation that's very real around when we cross the $3 billion mark.
Okay, all right. So that'll be sooner than expected.
And just one thing, just a basic fundamental point, Sudhir, how much of the revenues, and this is, we did an IT town hall recently, and we had Frank D'Souza, ex-Cognizant, and somebody from Fractal, and we had a whole bunch of people from the sector, and it would have been great to have you as well. But one thing which came out is that pricing will increasingly shift towards effort and outcome-based. At Coforge, is that already happening? All the outstanding business that you have to execute, could you give us a sense of how much of it is outcome-based?
It's increasingly and very quickly moving to outcome-based, Prashant, on an ongoing basis. As I've said always, for firms that are able to drive outcomes and orchestrate those outcomes for businesses, growth will continue to compound. It is compounding in our case. One of the largest, I suspect the largest program that we have running across the firm today, and I can say that with absolute conviction, is a 100% outcome-based program that we're running right now. So we've already made that switch, and more importantly than just making the switch, we made it successfully. So it is outcome-based, and those are the firms, as you rightly noted, which are going to compound in the future. Firms that keep talking about labor as a default and not outcomes are the ones that are likely to get left behind.
Sudhir, what percentage of your book today or revenue or order book would be outcome-based, outcome-led?
We don't call out that number in our results at the current point in time, Rima. Maybe going down the line, maybe a few quarters down, we'll start talking about it.
But you're saying this program to move everything to outcome basis is on. I mean, it's what you're actively. I mean, clients are of course asking for it, I'm assuming, but you're also sort of proactively moving towards it.
We prefer that. We prefer that, and we prefer that largely because of the integrity of our delivery model, the best example of which is 95% of our business is repeat. We believe that we will deliver against the commitments we make, and we're looking at a past record, not future projections. So whenever the option arises to even propose, forget respond, we do lead in, not necessarily always with 100% outcome-based, but with an increasing portion that is outcome-based.
So always a pleasure talking to you. Thanks a lot for joining in. Congratulations on the past quarter. And you look like you're going from strength to strength. So we wish you well, and we look forward to have a conversation at the end of the first quarter. Okay, it's time to slip into a short break. On the other side, the management of Blue Star is waiting by to detail their quarter four numbers and the trends ahead. Stay with us. Welcome back. This is Corporate Radar, and we had a lot of earnings, so let's address the next corporate on the show. We have Blue Star. That one, in fact, reported a mixed set of numbers in quarter four. Margins expanded big time, but the revenues came in more or less flattish. To help us understand what went on in the past quarter, we're joined by Mr. Veer Advani, the Chairman and Managing Director of Blue Star. Hi, Mr. Advani. Good morning. Always good to have you on the show, sir. Let's start off with the largest part of your business, which is the UCP business. Now, the margins expanded. That's great. Looks like some costs have been pushed down, and you all have done some cost efficiency measures as well, which seems to have played out. So give us a couple of details. The revenue growth is only 1%. Why was that? Have you lost some market share? And on margins, what's the sustainable number for the UCP business? Please go ahead.
Morning, Nigel. Thanks for having me. Yes, you're right. It was a mixed quarter, but I think better than expected, honestly. In the UCP business, you remember how the year started with a minus 20+% sort of hit to the top line because of the washed out summer. But we had mentioned at the beginning of the year that the aim would be to bring back revenue to a flat level. So, full year to be at the same level as FY25. We fell short of that. Full year, we're at, I think, minus 5%. However, if you look at the quarter, the fourth quarter, I think you'll see a strong recovery there. You remember Q4 of 25 was a very big quarter for us. Of course, we expected to grow faster in Q4. We were only able to maintain a flat growth. That was because the onset of the summer was later than expected. I think you know that March, there was not much of a summer around India. There was actually rains. That, of course, has changed in April. But for last quarter, I think revenue flat was better than we expected given the weather. And as far as the profitability is concerned, the EBIT did expand due to two reasons. One is, of course, we took price increases because of costs going up, but equally, we were able to cut operating expenses. So, of course, we may not be able to sustain a 10.4% EBIT in the new year because costs have, of course, gone up further. But we're still optimistic that FY27 will be stronger than 26.
So on UCP, then what would you like to guide? I mean, in terms of growth, and also if 10.4% is not sustainable, then what's the number you're looking at? And also the other query with regard to market share. Have you lost a little bit of market share?
Sure. So as far as market share, no. In fact, full year, we have gained market share, about 0.5%. So we are up to 14.25% now. So actually, it was a better year than expected on market share. Even for the quarter, we held our market share in spite of us raising prices and others delaying the raise of prices. So I think in Q4, in spite of price increases, we were able to hold on to our market share, which is encouraging. For the new year, full year EBIT margin for FY26 was 8.2%. We're expecting it to be at about 7.5% to 8% in FY27. largely on account of significant cost increase that I think you're aware about.
Right. Mr. Advani, good morning. What in the 40 days of this quarter, the quarter we are in, could you give us a sense of how this 40 days compares to 40 days a year ago?
So the 40 days, it's actually a mixed situation. I think the first 2-3 weeks of the financial year started slow, while, of course, the summer set in by about the 15th or so of April. What has happened is tertiary movements have been very strong, so that's extremely encouraging. You do know that coming into April, there was a glut of inventory in the field in the entire industry. So very happy to see that tertiary sales are moving well, which means that inventory is getting cleared out. Primary sales were a little soft in April, but May has started off very strong. So I think overall Q1 should be a lot better than Q1 of last year, as long as, of course, the summer continues to hold. I think May is looking positive, and if we're lucky, if the summer holds out till the middle of June, then it should be a good quarter.
It's expected to be a below par monsoon this time around. So maybe perhaps we'll have to deal with heat, and we need cooling most definitely. So maybe a bit of a bump for AC makers in that sense.
I hope so. We hope so.
Yeah, Mr. Advani, so, the other thing, of course, is input price rise. You covered margins and what you expect, right? But have you taken price increases? Will you have to take price increases?
Yeah, so we have already, usually we're the first in the industry to take price increases, and we've done that once again. So just to put it in context, we had a BEE table change that you're aware of, Jan 1, where the efficiency went up. Because of that, cost went up by about 5%. We did increase prices because of that and our new products that went into the market. In addition to that, there was an 8% increase in input cost, largely around copper, aluminum, and steel. That we have now passed on to the market partially. So Q4 was without that increase. April, we have passed that increase. Of course, we're not able to increase prices by 13%, 5 plus 8, but we've been able to increase price about 8 to 9%, and demand is still strong.
All right, we'll leave the conversation here. Mr. Advani, short one, but we've got a number of companies to report on. Thank you very much for joining in.
All right. Well, I think let's welcome in our next management. It's, corporate earnings treadmill, right? Running from one to the other, but that's earnings season for you. Bajaj Auto reported a strong set of fourth quarter numbers. Profits were up 34%. Margins came in healthy. And let's take it up with Rakesh Sharma, who is Executive Director, Bajaj Auto. Do also note that Mr. Sharma, of course, now has been elevated to the role of Joint Managing Director effective for June 2026. Mr. Sharma, congratulations are in order from all of us here. Good morning and congratulations.
Thank you very much. Good morning.
Sir, and let's just start this conversation. We'll get to, many of the numbers, but I just want to start with the other expense number, which is coming about 7% higher. It's about 26% growth on a year-on-year basis, where volume growth is about 24% on a year-on-year basis. Could you give us a sense of what this is? Is this all marketing spends? And what's the trajectory of this going to be in the future into FY27?
Yeah, it's not a very significant number for us, and it's a one-off, largely driven by things like marketing and all that. So it's not a really material line which we are monitoring.
What is it what is marketing spend as a percentage of revenue, sir? I mean, is that number likely to stay same into 27 as well?
Yeah, I must say that I am not fully informed on the exact details of the breakup of that other expenses. And, I could sort of get you a more detailed line, which then you can put out if you want later in your show.
Okay. But this is largely marketing spends, right? And you're calling that a one-off?
It's a combination of things. That's why it's not one significant chunk, but it's a combination of things.
Mr. Sharma, hi, morning. Now, you flagged off a cost inflation of 350 to 400 basis points in Q1 as things stand currently. And you've also gone on to say that only 40% of that has been passed on via price hike. Does that mean we're going to see margin pressure in Q1? If yes, what would it be? So Nomura has an estimate, 100 to 150 basis points of margin compression. So that's point number one. What would margins look like in Q1? And two, would you be looking to pass on the balance cost inflation via further price hikes? And if yes, what would be the, can you quantify that?
Yes, the cost scenario is indeed looking inflationary almost all across the raw material palette, led by things like aluminium and noble metals and polymers. We have sensed about 4 to 5% inflationary trend in terms of revenue. 40% of this was passed on 1st of April. Having said that, the situation is evolving. It is not as if, things get concluded, which ordinarily get concluded for a period of time, let's say a quarter or so. But this is evolving almost on a monthly basis. The great mitigating factors for us are that the US dollar realization, the rupee realization is helping us mitigate this inflation. Also, the mix for us and the operating leverage have been very useful in mitigating the inflation. And therefore, we are going to look at pricing in a very dynamic manner, month on month, and try to understand its potential impact on demand, observe what competition is doing and how the raw materials are trending. So it would be a very, very dynamic area to manage.
Price variation increases will be dynamic, but in Q1, will there be margin pressure? Margins lower than Q4? And if yes, can you give us an indication of how much?
See, that's exactly what I said, that we have taken 40% already on 1st of April. Now, let's see how the situation evolves in May. We will address it after evaluating the benefits from the exchange rate, look at competition, and again, look at what is the final settlement on pricing, and then raw material pricing, and then take a pricing advantage. So I can't tell you exactly that, these are the basis points to which the margin will go down. But yes, there are headwinds which one is facing. Now, it depends on how we solve for that, whether we solve for it through pricing and accept the consequential impact on demand, or we go for demand and not solve for solve through pricing.
You've also guided for a 7 to 9% industry growth. That's lower than the kind of growth we've seen in the last couple of months, which has been super strong. So can you tell us the reason behind that? And to any extent, has demand been weak on account of the Middle East crisis or the price hikes that already the industry has taken?
Yes, see, particularly in the motorcycle segment, there has certainly been a deacceleration between Q4 and April. Our forecasts are based not on some guesstimates, but purely looking at how April has panned out and an extrapolation of what has already happened, because it's very difficult to simulate the future in so many moving parts. So as you know, post GST, there was, quite strong growth, of almost 20%. Q4 was the motorcycle industry grew 20% in terms of registrations and only 9% in terms of in April. However, there is a little bit of shifting of the mini season, which is, the Navratri, the Ugadis, and the Gudi Padwa type of festives, which this year were in March and last year were in April. So there is a little bit of base effect, but then there is also price increases which have been put in place. There is a dampening of consumer sentiment because, the LPG shortages have entered into every kitchen in India and people are influenced by that. So because of all these factors, we are seeing the acceleration and a softening. But importantly, it would be good to unpack this 9% which we have seen in April. We see continued strong growth in particularly the 150cc plus segment, which is still growing at high double digits, high teens, and a rapid deacceleration in the bottom half of the market.
All right. Hi, Mr. Sharma. Congratulations on your new role and wishing you all the very best. Well, I have two questions for you. One is on the buyback. What's the clarity with regard to the promoter entity participating or not?
Well, the promoters are not participating.
All right. Makes it more lucrative then for shareholders. And just one more query. You need to clear out all the doubts and all the rumors that we hear in the market. Do you think strategically, Ola as an investment makes any strategic sense to Bajaj Auto, or there's no way you're going down that path?
Well, we are not looking for any acquisitions in the EV sector within the country. That much I can tell you.
That clears the point.
Just to take that point forward, Mr. Sharma, how is competitive intensity in that arena looking like? It's a topic we've discussed in the past as well. Is it on the uptrend? Is it stable now?
You mean to say in the electric scooters side?
Yes.
Yeah. The competitive intensity remains as it has been. As you know, over the last year, there has been a tremendous consolidation in favor now of the top three players. But within the top three, of course, there is a very strong intensity which is played out through pricing and marketing and product introductions and distribution management. And we expect that to continue. But having said that, the great thing is that consumer sentiment is strongly showing a preference for the electric side. And I guess with more and more fuel increases, which seem to be in the offing, we definitely feel that this segment will grow fast. So competitive intensity in a segment which is growing very, very rapidly is fine.
Okay. And we've not seen those price increases yet. Hopefully we will not before that the situation corrects and prices come off. But maybe we will. But that push towards electric, as you're saying, is becoming more apparent in that sense. Thank you very much, Mr. Sharma. Appreciate you joining us. And congratulations once again for the step up. Good speaking with you.
Thank you. Thank you very much.
Okay, we'll take a quick commercial break here. We'll come back. But before we take a break, let's just address commodities. Manisha is here in the studios to do exactly that. Manisha, take it away.
Thank you so much for that, Prashant. I'm looking at metals as a prices because while the crude oil prices after that 96 and are back to 102, it is the precious metal prices which really seem to be moving quite a bit. So I'm looking at gold and silver. Overnight has been very strong gains. I mean, as you can see, gold gained up by 3% in the overnight market and silver gained up by 6% as well. But when you look at a slightly longer term scenario as well, we have seen stronger gains continuing in case of precious metal prices. For this year till time, it's 9% apiece up for gold and silver. But when you look at the last 12 months, it is 42% of gains for gold, 140% up for silver as well. Interestingly, it is about the geopolitical tensions as well. The crude oil prices declining has supported the markets here. The dollar index also has seen a bit of a decline that in turn has supported the dollar-denominated commodities. And then with US-Iran perhaps in on one-page memo to end the war is what the street is looking at. US also has said that they expect Iranian response to come in the next 48 hours. And it also is that this page or this MOU would perhaps set a framework for a more detailed nuclear negotiations going forward. But remember, US also has said that they would resume military strikes in case Iran does not, or the Iran deal does not go through there. But I also want to talk about an important event that is going ahead, and that is going to be the US and China meeting, which is slated for the next week. That is going to be even more important to watch out for. So the next week, 6-7 days brings you US-Iran negotiations and then US and China meeting. So two important events for the global asset classes there. But for the Indian markets, the demand clearly seems to be slowing down, especially for the month of April and now in May as well. The first quarter of this calendar year was strong in sense of investment demand, imports, jewelry demand. We've seen all of those earnings from listed jewelry companies coming in as well. But when you look at the imports now, the April gold imports into India are slated to decline to a 30-year lows at just about 15 tons. Silver imports perhaps could be at around 20 tons, which is way lower than what we saw in the month of Jan and Feb. This is because the banks are hit by an unexpected tax demand. Let me explain that to you. So till times, since 2017, when you did see a GST come in, the banks were exempted from this 3% GST in sense of imports. But to that effect, there have been those notifications coming in regularly from the government authorities, from DGFT, etc. So the gold importing banks, as I said, were exempted from this 3% levy. But that notification has not come in after the month of March. So from April, because it doesn't let you fill a form or doesn't let you let go of that 3%, you're looking at decline coming in for imports. April has witnessed delay in authorizing banks to import bullion as well. So this is one thing after the other. Authority to banks, GST, and then you have gold dore as well, where you are looking at new licenses being delayed or rejected. So that just adds to the problem, with an impact that you are looking at way lower or record low gold imports for the month of April, and May isn't any better. The only reason that you haven't seen the prices run up is because the Indian demand also is kind of slow in April and May. The wedding season only starts from June and July, and that is what the street will perhaps look at. Let me show you the numbers as well. In April 2026, the gold imports is at 15 tons. Last year, same month, was 35 tons. This is after 2003 that you're looking at the lowest import figure of 15 tons in any month as well. So that is where the concern comes in from. Also, when you look at the first quarter, well, this year was really strong at 196 tons. The last 2 years, in the first quarter, we haven't seen that kind of a demand. So the first quarter, very, very strong. But the second quarter of the calendar year, slightly on the weaker side. India average monthly gold demand has been 60 tons in the last fiscal. Also, industry says that these delays perhaps could be to ensure that gold is becoming a high value ticket now. So markets perhaps could be looking at new policies coming in, or because current account deficit, the way the rupee has been declining as well, there could be some new policy coming in, is the reason we are looking at these delays coming in from the authorities.
Thank you, Manisha, very much for that. Moving on now to the next management, and that is CG Power. The company's reported a good set of Q4 numbers. The company's revenues have gone up by 25%. The EBITDA margins have expanded by 100 basis points to 13.5%. Profits ahead of estimates at 32.5%. And the order book has surged more than 60%. Amar Kaul, Group CEO, MD of the company, is now joining in. Thank you very much, sir, for joining in. Rima here. It's the power systems which is driving growth for you in Q4, solid, near 50% top-line growth. Now, given the order book and the visibility on the power side, what can you guide for the company's overall revenue growth next year? What are you gunning for? And in that, the contribution of power.
Thank you. Thanks, Rima, for having me here. Yes, I think the team did a good job in terms of the performance. And for your specific question on power, we are pretty positive about the way industry is growing, sustainability, focus, and also the power grid transmission that is happening, modernization of the grids. I think all that is building into the demand further, and we are pretty bullish on that as well.
Can you help with some numbers? And even margins expanded for the power systems business. EBIT margins hit 23.8% in Q4. Is that the new base? Can you sustain given the raw material volatility? So margins and even some indication of the growth pipeline on power.
Yeah, so it's a combination of multiple things. I think there's no one size that fits all. I think not everything came from the customers. It's also our foundational execution excellence that we have been practicing for last more than 2 years. Keep compressing the lead times, eliminate the waste from the system, make sure your demand and supply side is balanced on SIO processes, have that right forecasting. So there are multiple things. I can talk for 2 hours, what are the things we are doing that's actually showing those. So what you see is actually the outcome. But there's a lot of hard work which the team has been doing over the years on that. So we're pretty positive. Again, we are not giving any forecast on how the margins will look like. But yes, we always look at accretive margin growth. So which means when the top line goes up, the margins will also go up.
Yeah. Mr. Kaul, hi, morning. And we're talking to you on a day where it's very possible that the stock hits a new all-time high. I think it last hit a high of 874 back in October of 24, and we're about $15 away. So it's done phenomenally well from the lows, recent lows. So there is power which is growing gangbusters, but industrial systems is kind of looking, is on the other end, right? Some 12-13% kind of growth. So could you tell us what's happening there? Is it demand-related issues and between motors, railways, what exactly is going on?
Sure, I think good question, Prashant. Thanks to talk to you again. Yes, power, I think, because the market is on our side, which, because of the expansion, you know it pretty well. Industrial is not as great as the power sector, but it does not mean that 5 to 6% growth that we see on this industrial side. We are very close to those numbers. But having said that, what are we working on? If you remember last couple of quarters that I have been talking in earnings call or interaction with you guys, there's a lot of work which has gone into the motors piece of business. And I'm very happy to see the large portion of the motors, which is LT motors, it's kind of bounced back. It has reached the respectable double-digit margin that I was looking for. Again, that's not the end of it. There's a very clear roadmap over the next couple of quarters. How do we keep inching upwards on that? So I'm pretty much comfortable on the LT motor piece. Then we have the large motor piece of the business, which right now is undergoing that transition. Will take, I would say, 3 to 6 months more to bounce back on that as well. Our go-to-market strategy on that is activating not only in India, for outside India as well. NPD pipeline for R&D is also getting activated. So these are a couple of things that will help us to be at least 2x to 3x of the GDP growth in that particular market. So that takes care of one of the big piece of the industrial segment. Second piece is the railways business. That's going to take a couple of quarters more. We had recently leadership changes. We have very, very strong professionals who are running this piece. We activated a lot of NPDs on that, a lot of go-to-market. In fact, a couple of my guys right now are sitting in outside India doing that business development and developing those accounts as well. So it's not only for Indian Railways, but we are looking at markets outside India as well. So I'm pretty bullish on that product as well. But obviously, you'll not get results over the next few months. It will take a bit of more time.
And margins here, segment margins, would generally, because input prices are going up, cost pass-through perhaps a bit of a challenge here, or not?
I would say we have been able to mitigate that to a large extent. Like I mentioned last time, in the last 12 months, we have increased motors pricing almost by 17.5%. And a lot of it was realization. It's not that we passed the price and then gave the discounts. No, I think we're able to realize that. And that's why you see decent improvement in the margin. Again, we don't give each business-wise margin, but I mentioned that, it's already bounced back to double-digit margins. That's the result of balancing what you get from the market and also what you're doing from the productivity point of view.
Got that. Mr. Kaul, just to go back to power, where are we in the ordering cycle? You think a lot of the ordering, I mean, we are halfway past, or we are in this cycle, in this current cycle, where do you think we are?
I think the simple answer is, Prashant, that we have just started. It's the beginning of it. And if you see the jump of our order backlog is jumped by almost 60%. Our bookings went up by 30%. And the way I look at the pipeline is phenomenal, huge, and that's why you see a lot of focus on our capacity expansions to address all of those things. Today, honestly, the orders, that's not a big problem. It's a big issue is how quickly can we get our capacities in place.
Yep.
The technology piece of, because we being a large Indian organization, we are blessed to have all the technologies available, but I think our team is doing a fantastic job to build those in-house technologies to compete with the best in the world.
Yeah. And this is all domestic ordering, right? What you're saying, just at the beginning of it.
No. It's a combination of all. If you look at even exports, we don't give specific numbers, but just to give you an idea, for full year 26, financial year 26, we were 200% up on export orders. Okay. And for Q4 itself, we were almost 7.5 times more than Q4 of previous year. So there's a big focus on exports and domestic as well. So it's a combination of both.
So you've expanded capacity in terms of other action, corporate action, in terms of looking for acquisitions, because as you say, execution is the issue. Are you scouting for opportunities? I mean,
yes, I think we have this strategy team. We continue works on that. We will not be shy of that. If there's a potential opportunity that makes sense for us, we'll definitely go towards that as well. But I think what is in our control very quickly is accelerating the capacity expansion and probably just wait for a quarter more. What we are looking at, typically, the kind of product we have, it takes close to 2 years, 24 months to set up a new factory. And we are seeing how do we compress it from 12 to 14 months. So those are the things, on lean manufacturing basis, what we are working on. And that itself gives you 1 year leverage of being ahead of the curve.
And on the OSAT semiconductor piece, I mean, things progressing well. Can you give us an update?
Yeah, OSAT, as I mentioned last time, our G1, which is the mini plant, making about 500,000 chips a day, that's already operational. And just waiting for some customer approvals. I think next 1 to 2 quarters, we should be done with that. So it'll start producing as per the specs of the customer. And G2, which is the mega plant, which is about 14.5 million chips a day, that is going as per the plan. So between December to March is the time frame of this year that it'll be ready for production, and then give it about 2 to 3 quarters more, because that's the time it takes for customer approval and testing, etc. So sometime in 27 and or something, we should be ready with both of these opportunities on the OSAT piece.
So somewhere halfway FY28, this will be completely up and running.
Yeah. So that, and then there's a gradual ramp up that is as per the plan. But the good news is, I think the team is doing a fantastic job. So that in terms of the timeline, etc., we are exactly on that.
Okay, Mr. Kaul, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Thank you for that commentary. As I said, CG Power is not very far away from a new all-time high. We'll see if that is to be today. 10 points lower, 24,321. We had a bit of a flourish at open, which has cooled off completely, and we are now flat. We take a break. We are back. More coming up on the other side.
Welcome back. Well, it's Sensex weekly expiry today, so it's a good time to take an update in terms of what is the options data telling us. Well, the 77,000 put, that's one of the active strikes today, and the premium on that particular strike has come down. Now, in the last few minutes, I think there's a bit of a pop-up out there as well, but otherwise that premium had come down lower. There is a sense of some writing at that particular level. Even the 78,000 put, well, there's a mix of activity actually at that particular strike as we speak. The premium's not moved too much. Remember, the premium's around 240 rupees or thereabouts. That's 78,000 odd, which is higher than what the current rate on the Sensex is. Sensex is roughly around 77,900 odd. So when you're looking at the 78,000 put and the premiums around 250, for those put writers, they are hoping that the level of around 77,700 odd does hold out for today's trading session. And there is some signs of, out of the money buying as well. I think at around the 78,200 call. The premium out there as well comes up for you on the screen. So we'll keep an eye out on that particular strike. Moving to the levels that you're tracking for today's trading session, you don't want the 20, you don't want the 50 DMA, both of them to break on the downside. That's at around 77,500 also. You'll have to keep an update on that particular front. But otherwise, if this level does hold out, that's the 20 DMA and the 50 DMA, then you'll have your eye out on the 100 as well as the 200 DMA. That's close to around 2,000 points away from current level. So you want to keep an eye out on that mark for the time being. That 77,400, 77,500 mark appears to be the level of reference on the downside, and you'll want the market to trend higher from here on. But it's weekly expiry, so keep an eye out on the second half of trade. Things could get rather volatile on that front. Well, we'll slip into a short break, though. On the other side, we have a special Market Master segment. Lata speaks to Sridhar Shivaram of Inam on how Indian companies compare with their emerging market competitors. Stay with us.